Gary Reynolds, Chief Investment Officer at Courtiers, is with me right now. Gary, a recent piece that we issued, written by Head of Asset Management Jake Reynolds, talks about Big Macs and Billy bookcases, while the rest of the country seems to be talking about the Prime Minister and the Chancellor. So what's a Big Mac and what's a Billy bookcase, and what's the relevance?
Well, the Big Mac index has been around for quite a few years now. It's a very simplified way which the economist invented to explain exchange rates. And the theory with exchange rates is that the cost of something should be the same around the world. So when you use the exchange rate to adjust something sold in dollars back to pounds or something sold in pounds back to euros, you should find out that the exchange rate makes that item cost the same whether you're in France, England, or the US. And what they effectively do is say, what's the price of a Big Mac in New York? What's the price of a Big Mac in the UK? If you divide one by the other, you should get the exchange rate, but you don't. What you find out at the moment is that a Big Mac is significantly cheaper in London than it is New York, and that would suggest that the pound is deeply undervalued. And then on a same theme, the IKEA Billy bookcase was just taking exactly the same principle and using a different item, because one of these things I think is sold every 5 seconds or 5 minutes. It's in the article around the world, and so it's a global item, and on that measure as well, the pound is drastically undervalued. So the point that Jake was making in the article was that it looks like sterling has been dramatically oversold.
Gary, we've seen obviously significant impacts in the markets and on our clients' portfolios. What's your view on the impact the Bank of England bond buying to stave off the effects of this so-called budget? And how does it all sit with the Courtiers investment strategies that you've been talking about so long?
So the Bank of England intervention was to supposedly help out pension schemes that had been hedging the movement in their liabilities by borrowing money to acquire very long-dated gilts. And as the interest rates began to rise, the value of those gilts was plummeting, meaning that margin calls were being made on the pension funds and they were losing liquidity. So the Bank of England stepped in to bail out a lot of pension funds. Now, it was, in my book, ludicrous that those pension funds were leveraging to buy long-dated gilts at crazily low yields. And a lot of it is to do with the way in which guidance is given to pension funds these days and the way in which actuaries encourage trustees to remove risk. And this left a lot of pension funds very vulnerable. And I guess the Bank of England felt obliged to step in, because a lot of those pension funds would argue that they're doing no more than act in accordance with the guidance from the pensions regulator. So in stepped the Bank of England. But it's odd, Leo, because on one hand, you're pushing up interest rates, and then you're stepping in to bring long-term interest rates down by buying your own bonds, which is a form of quantitative easing. And I think what's happened in this year, particularly with the UK market and the bond market, is the chickens came home to roost. There's been far too much QE, far too much driving down those long-term interest rates, and eventually the market stomached it no more and pushed those interest rates back up. But let me say that those interest rates are still not back to their long-term average. So they haven't gone particularly high, they've just got off the bottom. They're not into above average territory yet. So you've still got to watch those. If you're holding long dated bonds, you've got to watch them pretty carefully. Although our best guess is that the worst is probably behind us.
How are Courtiers investment strategies mitigating against the negative impacts on markets?
Well, Courtiers has mitigated brilliantly. I'm extraordinarily pleased with the work the team have done, bearing in mind that Courtiers can hold up to 60% in equities and 40% plus in bonds. So if there was one fund that was going to get caught out with the fact that at one stage, long-dated gilts has sold off nearly 50%. It would have been cautious. And it hasn't done anything like that. It's been pretty defensive all year. It's lost a few percentage points, but nothing major. So I think it's done its job for people investing in it who are investors that have got a below average risk appetite. And the other two funds have done well too. Of course, growth has lost about what you'd expect it to lose, and I'm pleased with that because generally growth pushes the envelope on risk. And so when you get markets selling off massively, and you've got one stage the S&P 500 down over 20%, mid caps in the UK down nearly 30%, it would be very easy for growth to have lost a lot of money, but it's off about 13-14% so far. Now that's not insignificant, I accept, but it has been defensive relative to the type of markets that you'd normally find it invested in. So not a great year for investors, Leo. You know, whether you're bond holding or equity holding, you haven't had a great year. If you sat in cash in dollars in, say, Wells Fargo Bank in New York, congratulations. If you're converting back to sterling, you've just made a lot of money. But that's probably the one place where you could have found yourself doing extremely well. Everything else has been very difficult. So our funds have done their job. You know, we don't promise they're never going to go down in value. We got people have been with us investing for 30 years. They know we ride the ups and downs. And what we do is make sure that we don't blow the portfolios up under their feet, like some well-known funds have done in recent years. And I think that's a credit to the investment team with the risk analysis work they do that we've got through pretty unscathed so far.
I noticed a slight uptick on the growth fund in particular overnight. Now, we've got talks going on with the OBR Prime Minister Chancellor today. May well have taken place by the time we actually get to release this video. Now, I'm not going to ask about U-turns and things, and frankly, I can't see there being any off the back of the response there's been to this so-called mini budget, a phrase which even the BBC has been told to steer clear from. But is this a short-lived bang, Gary, or are you expecting slides to continue? What can you see in the run-up to, say, the seminars in December?
It's a brave budget. And in fairness to Truss and Kwarteng, they really have nailed their colours to the mast. They've said we want to reverse the incessant increases in taxes that the country has had. You know, I said previously that this is the biggest take by the government on its population since the late 40s. So the Tories became a big tax government under Boris Johnson, and Liz Truss said she was going to reverse that. So she cancelled tax increases and or planned tax increases and reverse some other taxes and put more money into people's pockets. It's a very, very brave move. But if it increases demand, which hopefully it will do, the next stage that this government have got to do is to make sure that we've got the capacity to meet that demand. And one of the things that companies are short of at the moment are workers. It's more difficult to bring in people from the EU post-Brexit. And so we're suffering from a lack of immigration, would you believe? Unemployment's down at its lowest rate since the early 70s. Job vacancies are at record levels. You know, it looks like the economy is ready to take off if it can get the workers, and if they can free up the labour market, which they're now trying to do, and get some capital investment on the go, then they've got every chance of improving the rate of growth in the economy. I'm not sure they'll get it to 2.5% anytime soon. Perhaps they will, but it is a bold move. And they're not going to reverse it now. That would be a disaster. They'll keep it going, and they've just got to hope that if it is effective for the economy, that it's working by the time they go to the voters in 2024. It looks like if they're going for the voters today, it's a bloodbath for the Tories. So, but I don't think there's no going back now. Alia ictar est, as they say. The die is cast. You're going to have to get on with this government and see what happens over the next 2 years. But I don't think there'll be any major shocks now. This is now about policy and making it work. So I think we've got the worst of it out the way.
So Gary, 2 more points I'd like to make. I'm mindful of time. Number 1, message to investors right now. One would be pick up the phone and speak to your advisor. What would you say to investors, Courtiers?
Well, because of the sell-off and because of the way in which we've been selecting stocks, the relative value in the holdings that we've got in the funds at the moment is looking very, very attractive. Our equity holdings are remarkably low price earnings ratios compared to the market. We are starting to buy long dated bonds again. We bought an 11-year bond recently and got a yield of just over 4%. So, where I said we've been out of long dated bonds for a long time and that proved successful, we're beginning to go back in. And I think the prospects for the next few years are actually very, very good. All the experience we've had, and all my personal experience was the decades that have been working in financial services, is that sometimes you get paid back very quickly and sometimes it takes a little bit longer. But if you stick to getting quality in the portfolio and don't ever compromise your approach to risk, in other words, mitigate risk whenever and wherever you possibly can, then you win in the long run. We've probably got a bit of volatility still to get through. People are still pretty nervous. But if inflation has peaked, and you don't need it to start coming down dramatically, but let's take a view and let's say that inflation in the US, the rate of inflation at the US at least peaks and starts to slide a little bit. If there's a signal that the Fed are not going to keep increasing interest rates at the rate expected, then that will be pretty good for the equity market and probably pretty good for the pound versus the dollar. So it's a tricky thing to negotiate, but we've been holding dollars, but we've started to sell them off now. And the reasons are in the article that we issued on Thursday. So I know we've got some awkward times to get through, and against that, I know there's some outstandingly good value holdings in the portfolio right now. So it probably, Leo, when I'd probably say that most times. It's you're always thinking long term and then just trying to negotiate the short term, and I think that's no different here. But at least what we've done, at least we avoided that horrible bullet from the bond market, which has whacked the value of some investors' portfolios, and that we didn't pick up any of. So I'm very pleased with that.
Gary, thank you for the insight. Now to wind down, I know the investment team's been working very hard along with other teams across Courtiers to add to our existing range of Courtiers funds. Now, these are all designed to appeal to varying investor attitudes and risk appetites and the likes. And we're about to see a new Courtiers Ethical Value Equity Fund added to the range. What can you tell me about that?
EVE, Ethical Value Equity Fund, EVE, we've nicknamed the fund internally. It's a very, very exciting development. We know that some investors like to apply their morals and their ethics in investing their portfolios. We have in the existing portfolios tended to avoid sort of the mainstream tobacco companies and the big polluters, but we've gone a stage further and we've said sort of identifying key criteria of what does somebody who wants to invest ethically want to invest in, or specifically what do they want to avoid. And we've said they don't want to invest in tobacco, as a lot of people don't want to invest in alcohol, they don't want to invest in in adult entertainment. They don't want to invest in the big polluters. And the thing with Eve is, if you go into this fund, you won't invest in any of those. Now, I should add that this is enabling people with certain views to invest. It's not reflective necessarily of the individual views of the investment team, and different people have different views on team as to whether they would or wouldn't, say, invest in alcohol or tobacco. And I would guess, Leo, with as you and I like a glass of wine, we would be more relaxed about investing in alcohol companies. But, it doesn't suit everybody. And Eve is intended to give those people that want to invest in a range of ethical considerations and in a way that's good for the planet. So we obviously are very keen on the environmental issues. You've got a basket of stocks that should meet the criteria, but very importantly, it's got all the same risk testing procedures that we use on our other funds, and we are selecting value-based equities. So we're looking for companies with good metrics that are ethical. So we don't want the ethics to trump the risk controls and the long-term value, and that's quite key. And I've got to say, it's been. I'm really surprised we got it launched so quick. It's taken quite a while, but the FCA have been really helpful with this, and credit to them. Our compliance team have been fantastic, and the guys on the investment team have really worked hard to get it done. So, touch wood, it's going to be a good addition to the range.
Gary, thank you very much. We're going to leave it there. We've got eyes on the growth plan 2022. We've got eyes on the markets, eyes on Courtiers' investment strategies and performance, and eyes on December, when we look forward to welcoming you and the investment team on stage at the client seminars. Gary, thank you once again, and I'll talk to you soon.